Section 32 is all about depreciation. In PGBP, if you complete the chapter depreciation, the content depreciation, almost 40 to 50% of PGBP is over. So the most important sections. The depreciation, what you calculate in your financial account, will not be applicable under this. Okay. Higher the depreciation is most beneficial to the owners, because of depreciating, your profit will be decreasing. As the profit is decreasing, there is no any cash outflow. The cash is in your pocket only. Because of this one, the profit is lesser. You are paying tax lesser for the lesser profit. So outflow for the taxation because of the higher depreciation will be lesser. It will be a savings for you, okay, currently. Maybe anyhow it may be reflected later on. So whenever the government says you can claim the depreciation, you are pretty happy. You are pretty happy. Because of debiting this, there is no cash outflow. That cash is in your hand only. Clear? That's the logic. Sometimes the value of the asset being 100, how much you can depreciate this over the lifetime? 110 also. So if the government says you can debit 110 rupees for the 100 rupees of your asset, it means government motivates you to purchase the asset. Because of purchasing the asset, you will be able to debit 110 rupees in your P&L account. To that 110 extent, your profit will be decreasing. Further, if the tax rate may be 30%, 33 rupees you are paying lesser to the government. So actually 100 minus 33, 67 is the outflow. 67 is the outflow. So depreciation is a good example, okay, for benefit offered by the government to investors. Is that okay? If you go and ask your parents, I need 1,000 rupees. I need 1,000 rupees. The next question is what? What's the purpose? First day, first social. Immediately your dad says, wait for some couple of days. Anyhow, it will come in the OTT or some other platform. You can see at free of cost. Don't spend this. Else, if you say 1,000 rupees one day seminar, if I attend, their success rate will be 70% in CA. Your dad immediately says, 1,000 rupees only, take another 1,000 rupees. Don't delay. Don't delay. Join and go by auto, or I will come and drop. All the facilities will be there. Here, it will be totally different. First day, first show. Here, the situation is totally different, right? So, if it is being the right cost, your parents are happy to spend that. And if it is not good cost, means if your parents think so, you think this may be the good cost, right? Whatever it may be. As per their opinion, your parents is not willing to spend for the first day, first show, right? So then this money will be restricted to spend, and this money will be allowed to be spent even double time. For the 1,000 rupees, your dad is willing to pay 2,000 rupees. So it means ultimately you will be having 1,000 rupees in your pocket for other purpose. Similarly, government says you can debit 110. It means 10 rupees excess debit will be in your pocket, being your cash benefit. Right? That's the logic. So depreciation is one of the beautiful benefit earlier offered by the government to the investors. Now we don't have, as per the new tax regime, it's restricted to only 40% and overall only 100%, not beyond that. So earlier we can debit more than that also. Now we don't have that depreciation allowances. This is called depreciation allowances, right? Now, whatever the depreciation you study in your financial account is for financial accounts purpose. See, in your P&L account, GP 1,000 and the depreciation 200 rupees, other expenses being 600 rupees and net profit being 200 rupees. Is that clear? This depreciation, what you calculate, is as per the financial accounts rules. Either straight line method depreciation or written down value method depreciation. In case of company, they could have created the depreciation based on the accounting standards, and Ind accounting standards may be adapted, right? But this is how the P&L account is prepared. This is how the P&L account is prepared. But this is for whom? For the investors, for the shareholders. Okay. For the taxation department, they prepared a different P&L account. Net profit as per the book is 200 rupees. The 200 rupees debited in your P&L account for the depreciation calculated as per the financial account, is disqualified. If you disqualify this, what happens? Your profit will be increased by 200 rupees. Add the depreciation as per the financial accounts. 200 rupees. Then what can I do, sir, for the depreciation? You have to follow the provision given under section 32 of Income Tax Act. As per section 32, the depreciation can be claimable here being probably Income Tax Act. Okay, probably 300. So you can add 200, subtract 300, only 100 rupees will be your income for the taxation purpose. For that, you have to pay the tax at the rate of 30%, 30 rupees only payable. Actually, as per your financial account, you earned 200 rupees profit at the rate of 30%, you have to pay 60 rupees, right? But by applying the income tax rules, the depreciation may be claimable different value. If the value is higher than the depreciation actually claimed in your P&L account, then your profit will be decreasing for the taxation purpose. For the decreased value, you have to pay the lesser tax. If the income tax department says, no, sir, you are eligible for only 50 rupees, then what happens? 200 plus 200, 400 minus 50, 350 will be your income. 350 will be your income. You have to pay tax at the rate of 30% on this 105. So you have to pay higher. This statement of profit and loss is for what? For the income tax department. This statement is for the public purpose. So if you are referring the financial report presented by any company in any of the sites, right? Even in moneycontrol.com and all, you can download the financial reports of any listed company. Okay, those P&L account are nothing but the P&L account prepared as per the Ind accounting standards. Where for the taxation purpose, this value is totally different. The profit will be totally different. So if you go and cross check company's tax rate being 30%, so can I calculate and find out whether the tax being the same value for this profit shown by the company? Means it will not be. So because the tax may be 30 rupees, but if you apply 30%, it comes 60 rupees, you will get confused. Sir, as per the tax, it may be 30%, means it should be 60, but this company has paid only 30, sir. How this one happens? How this one happens means you have to prepare the P&L account differently for the taxation purpose. Is that clear? Now, depreciation could be of two models. One is SLM method, another one is WDV method. Okay, two methods are there. But for the income tax purpose, you have to follow WDV method predominantly only for power generation and distribution. For that company only, they can have the option to go for either SLM method or WDV method. For whom? Power generation and generation come distribution. Okay, either I may power generate or I generate and distribute. Involving these two activities, then I can claim the depreciation for my assets under SLM method or WDV method. Clear? Otherwise, you have to follow only which method? WDV method only. So very simple. In all the cases, you can claim the depreciation under WDV method only. SLM rare. If you go for calculating the depreciation under WDV method, how can we calculate, sir? Very simple. You have to calculate based on block of asset concept. So you can claim the depreciation based on the block of assets. But in case of SLM, individual asset can be considered for the taxation purpose. Individual assets. Block of asset means, okay, same kind of asset as well as same rate of assets, same rate of depreciation. Okay. If the asset being the same kind, plant and machinery, furniture and fixtures, building, okay, we may have the guest house or we may have probably a residential building or a factory building or administration office building or furniture fixtures. We have the furnitures, cupboards and any other fixtures. All the furniture fixtures are considered as fixtures. Furnitures only, no, group that. Compare whether the rate of depreciation for all these things are same. Yes, sir. Then group all the assets into single block. You can claim the depreciation for all the assets put together in single value itself. Is that okay? That's the logic of block of asset. Same kind of assets, same rate of depreciation will be grouped. Same rate of assets, same kind of assets, same rate of depreciation will be grouped. So here the list is given. For example, in case of building, we have three blocks. In case of residential building, you can claim the depreciation at the rate of 5%. In case of office, factory, godowns, road inside the factory or water well, all these things are again related to the building. These things carries 10% rate of depreciation. Any temporary structure, wooden structure or temporary structure, time being it's constructed, later it's going to be dismantled, then that will be eligible for 40% depreciation. 40% depreciation. Is that clear? Similarly, furniture fittings are depreciable at the rate of 10%. This will be a block. I'll explain all these rates and other things later with a small mind map to keep in your mind easily. Right. Let me now start with an example here. So, plant and machinery. Usually, nothing stated means the plant and machinery will be a block carrying 15% rate of depreciation. Okay. Plant and machinery. Opening WDV of the plant and machinery. In the year beginning, we have around 5 assets. 5 assets. The opening WDV of all the 5 assets put together, say 10,000 rupees. Now, during the current year, if you purchase any other assets following the same block, to consider the asset being a part of block, what to be verified? Will it be a block? Will it be the same plant and machinery carrying the same rate of interest? Sorry, depreciation. If it carries same rate of depreciation as well as it is falling under the same kind of asset, then it will be considered for that block only. Assume that one more new plant and machinery is purchased. So you have to add that purchases here. Okay. This is also one more plant and machinery. It carries 15% rate of depreciation. The value being 2,000 rupees. That should be addable. So after adding that, the value being 12,000. How many assets we have? In the year beginning, we have 5 assets. Another one new asset purchase also falling the same block. To consider that the newly purchased asset falling in this block, verify will it be falling in the same plant and machinery asset type, and it carries a depreciation rate at the rate of 15%. If these two questions are answered yes, then automatically it's a part of this block only. It should be added here. So with the 10,000, 2,000 rupees is added, 12,000 rupees minus sale of any asset in that same block in that year. So already we have 5, one more new asset purchased. Among the 6 assets, 2 assets were sold. 2 assets were sold. Probably these 2 assets sold for 4,000 rupees. Now ended with what? 8,000 rupees. Okay. For that 8,000 rupees, you can claim the depreciation at what rate? The block carries 15% rate of depreciation, means for this 8,000 rupees, you have to consider 15%. So which is 1,200 rupees. Then the value what you get is nothing but closing WDV value. How many assets now you have? 5 minus plus 1, 6, 2 sold. Now we have 4 assets, value being 6,800. This is the opening WDV for the next year. The amount depreciation can be debited to the P&L account as per the tax provision being 1,200. Is that clear? So this is called block of assets. We don't calculate the depreciation for each and every asset independently. Okay. Now see, plant and machinery, opening WDV of the block being say 10,000 rupees. Number of assets exist in the very beginning being 4 assets, and one more asset purchased during the period. Okay, it carries rupees 2,000. So overall value being 12,000. 5 assets we have. In this year we have a sale being 5 assets sold. For how much? 10,000 rupees. Now what is the balance you have? 2,000 rupees. How many assets you have? 0. You don't have any assets, but that block has some positive value. What does it mean? Without any asset, if the block has any value, it means it is irrecoverable amount, may be loss, named as capital gains. It will be named as capital gains. Anyhow, we will be studying that along with the capital gains chapter under section 50. Okay, here I just give a briefing. There, that illustration here we will discuss in detail. There I am going to skip and do a small reference here, right? 20,000, 2,000 rupees. This 2,000 rupees is called capital gain, short-term capital gain or loss. Suppose I sold 3 assets for 15,000 rupees. What happens now? 2 assets we have still. What is the value now? 3,000 negative. Can I calculate the depreciation? The value is already less than 0. We cannot calculate the depreciation. Then what happens here? Again capital gain. So to consider whether can we calculate the depreciation for the year or not is decided based on the two numbers to be verified. Okay, one is there should be existence of the assets after the sale. Second one is the value should also be positive. If these two things are there, then you can claim the depreciation. Else you cannot claim the depreciation. Is that clear? So first part here. Now, now you can claim the depreciation if the balance is positive as far as asset exists, then you can claim the depreciation. Else you cannot claim the depreciation. So opening WDV of the block, probably 5 assets. Cost of the newly purchased assets may be another 2, 7. Actual sale value of any of the assets, probably 3 assets sold. So 5 plus 2, 7, 3 sold means automatically we have 4 assets. Asset we have 4 and value is also positive. This is also positive. This is also positive. Only then you can claim the depreciation. You can claim the depreciation. Is that clear? Hope now you will be able to understand the first block, first concept here. If the balance is not positive or not asset exist anymore or both not available, then what we can do, sir? Then directly jump to the second step to calculate short-term capital gain or loss. Short-term capital gain or loss under section 50. Clear? Now, the WDV of the plant and machinery on 1424 of SSA Limited engaged in manufacturing of PVC granules 3000 lakhs. 3000 lakhs. Okay. So WDV on 1424. Opening WDV. What is the value? 3000 rupees. Company purchased additional plant and machinery for 1600 on 18/4/24. So add purchases. When the asset was purchased? 18/4/24. Okay, 1600. Inclusive of second-hand machine imported from Ireland 400 to increase its installed capacity of production from 1000 tons per annum to 1500 tons per annum. So they have purchased new assets for 1600, which includes a second-hand machine for rupees 400 lakhs. Okay. The production from new machine commenced on 1/12/24. Work out by giving reasons the amount of allowable depreciation. So the overall value being 4600. There is no any sales. You can claim the depreciation. You can claim the depreciation. Is that clear? If nothing stated, plant and machinery general clause will be 15%. You should not have any doubt. So I'll give the briefing about the rates and blocks in detail in the next class, right? So you just understand. In case of default plant and machinery, the depreciation for that being 15%. So plant and machinery, 15%. Now what is the depreciation you can claim here? Okay, 630, 90, 690. Okay, but here date of purchase of the new asset is given. The date of purchase of new asset is when? 18/4/24 given. Is that okay? 18/4/24 is given. Clear? But from when we started using that asset? The newly purchased assets to expand the capacity from 1000 tons per annum to 1500. But any of that new plant got activated only from 1/12/24. So though the purchase date being this one, but usage date is this one. Put to use is from 1/12/24. From the put to use up to the year end, cross verify whether it is more than 180 days, 180 or more 180. Okay, more than one, either 180 or more than 180 days. If it is more than 180 days, then it will carry full year's depreciation. Else you can claim the half year depreciation only. So from this date to 31st March 24, rough calculation, right? 4 months only. 4 into roughly 30 means 120. It's not 180. So you can claim the depreciation only for the half year. It is not from the date of purchase. It is from the date of actively used or passively used or used. What is called actively used and passively used? We'll discuss that later on. Anyhow, you have to understand put to use is the date. From the put to use date, Up to the 31st March, the date of usage, the days of usage may be 180 or more, then it can carry full year's depreciation or it will carry only half year's depreciation. So, depreciation. Half year depreciation at the rate of 15%. For what? Out of 4,600 newly purchased asset, 1,600, for that you can claim only for the half year. Okay, 120, am I right? 120. Remaining balance, for that 15% you can claim. So 15% on the remaining balance. How much is that? 450. The overall deduction being 570 can be deductible. Balance being 4,030. 4,030. Is that clear? Correct? Just to think over. Is it correct? Yeah. Hope you will be now able to understand. Now, under default tax regime under section 115 BAC, what we have calculated is correct. What we have calculated is correct under default tax regime. In case shift out of the default tax regime, any new asset purchased, especially it is supposed to be used within the factory, you can claim one more depreciation to motivate to invest. Government always gives higher depreciation. Higher depreciation, that will be called as additional depreciation. That will be called as additional depreciation. Anyhow, you'll see that in detail later on. Here, as per the additional depreciation, you can claim 20%. If the put to use is more than 180 or 180 days and above, you can claim 20% flat only once in a lifetime of the asset can be claimable on the new assets. New assets, not second-hand assets. So this 400 is a second-hand asset, it's not eligible. Out of 1,600, 400 is a second-hand machine, another 1,200 will be the new asset. The additional depreciation, if you are shifting out of the default tax regime, you can claim the depreciation on this at the rate of 20% in a year. Only once, not every year, in the very first year. That too, in the very first year, if you put to use is less than or equal to 180 days, you can claim only 10%. In the next year, another 10% can be claimable. So as per this provision, this 1,200, 1,200 rupees. In this year, put to use being that 1st December, right? So it is less than 180 days. So it carries only 10% depreciation is equal to 120. You can further depreciate 120. This will be available only if you are shifting out of the default tax regime. Next year, again, another 120 can also be deductible, stating it is an additional depreciation. Thereafter, you are not eligible. Thereafter, you are not eligible. Here, this is the logic. Clear? Now, so to understand the 180 days, come on. Purchased in the previous year and put to use less than 180 days, only 50% is allowed. Purchased in the prior to the previous and put to use. So first let me finish up this question. Okay. What does it mean, sir? After 110 of the previous year, if you are purchasing, you will be eligible for claiming only 50%. Okay. Only 50% can be claimable. Let's now try that. Now, yes, 1st April 2024 to 31st March 2025. Okay. 3rd October 2024. If you put to use anywhere between these days, usually 180 or more days may be used, like then you can claim full year depreciation. From 4/10/2024 onwards, up to this date, if you are using, it may be less than 180 days only. So it carries 50% depreciation. Cross verify that. In the month of October, 31 days are there. 3 days, you remove 3 days. Okay. So you can use 28 days in October. November 30 days, December 31 days, Jan 31, Feb 28 days, March 31 days. Come on, count these number of days. 179. So from this it is very clear, if you are using from 4/10/2024 or later, the number of days that asset used for the business purpose is less than 180 only, 179 or less than that. So it carries only 50% depreciation, only 50% depreciation. Is that clear? Hope now you will be able to understand. So you can remember the date, 3rd October or earlier carries full year's depreciation. After 3rd October means 4th October or later carries only 50% depreciation. That's how you can easily remember the date also. Remember the date. Clear? So 1/4/2024, 31st March 2025. Okay. 1/3/2025 put to use of the asset. So the put to use of a newly purchased asset being on 1/3/2025. Originally the asset was purchased on 1/1/2024. This is the purchase date. So previous year 1/4/2023, previous year 24/25. In this period not at all used. For the current year it is not used only for this period. March 30 days only used. Okay, March 30 days only used. Come on, tell me, what about the depreciation for the previous year 23/24? If the asset not at all used, you are not eligible for claim even single penny as your depreciation. What about for the year 24 to 25, previous year 24 to 25? It is used only for 30 days. Come on. What is the rate of depreciation eligible for this? 100% will be eligible. 100% will be eligible. You understand? Why? Here I just explain. Any newly purchased asset is added here, also a part of WDV. This becomes opening WDV for the next year. Okay. Assume that the newly purchased asset, not at all used. This is not at all used. Okay. If it is not used for the 1600, depreciation at the rate of 15% claimable for 0 month. Remaining value 3000 eligible for full year's depreciation 15%. 450. You can subtract the 450 here. 4150 will be the WDV on 1/4/25. Next year, claim the depreciation here. Now tell me, is there any newly purchased assets in that block in that previous year? No, sir. Whatever the WDV we have now for the entire WDV, you can claim at the rate of 15%. If you calculate 15% on this, what is the value you are getting? 622.5. Clear? Once it is included in the block, thereafter we don't have classification of usage less than or more than 180 days. Hope now you'll be able to understand the logic. Let's get back. I have completed the point number 5 here. Purchased in the previous year and put to use less than 180 days or after 3/10 of the previous year. Yeah, of course, in case of leap year, it will be totally different. Okay. In case of leap year, rather now we have 25 only, no? 2025, it's not leap year. So you can take 3 being the cutoff date here. 50% allowed. Sixth point, purchased in the prior to the previous year and put to use is less than 180 days. Prior to the previous year. But in the current year, we have used only for a day or we have not used. What about the status of depreciation, sir? 100% is allowed. In the previous year in which it is purchased, no. After the depreciation, it is included in the block of assets as a WDV. Thereafter, we don't have such classification. Thereafter, we can claim the depreciation on the WDV as a whole. That's all. 2 points. So depreciation can be claimable from the date of put to use, not the purchase date. Put to use date is the matter. Then what is called put to use then? Put to use may be actively using or passively using. Whether you are using it actively or it's not used but it is actively available or passively available whenever it's in need. Very often there is a power shutdown now and then. So what can I do? I can go for buying a generator. I purchase the generator to safeguard from my job to be interrupted because of power cut. I purchased it. The moment I purchase, since then there is not even single moment power cut for the entire year. The generator remains idle. Okay, so always will go with the preparedness, but nothing will happen. Okay, so same happens me also. So I purchase the generator, but there is no power cut. The generator remains idle for the entire year. Will it be eligible for the depreciation? Yes, eligible for depreciation, because whenever the need is there, this will be available. Now it's a standby equipment for the emergency I have to use. So this is called passive use. Standby equipment are ready to use whenever the need arises. In that case, that will be called as use only, but that is not active use, passive use. You can claim the depreciation not only for the active use, even for the passive use, you can claim the depreciation. So point number 4. Active use and passive use. That passive use is otherwise named as ready to use. Ready to use is nothing but standby asset. For that, depreciation is completely allowed. Depreciation is completely allowed. Hope you will be now able to understand this point. And in case of hire purchase, if you are purchasing the asset in hire purchase, okay, cash price being 1000, A, B wants to purchase a plant and machinery from A. Okay, A says the value being 1000 if you pay immediately. Sir, I could not pay immediately. I need to get at least 3 or 4 years hire purchase scheme. Okay, I will give. For the delayed payment, I charge extra. Probably another 500 rupees you have to pay. You have to pay 1500 rupees. For the ready cash, you just pay 1000 rupees. If you are delaying, you have to make a payment of 1500. That 1500 is now named as hire purchase price. In this case, this 1000 rupees is called principal component and this 500 is called interest component. Now tell me, the asset is transferred from A to B. Who is able to claim the depreciation for this asset? Whether is it claimable by A or B? Who is the owner in case of hire purchase? Seller or buyer? Who is the owner? In hire purchase, who is the owner? In hire purchase scheme, who is the owner? Then that's a problem. What is called hire purchase? What is called hire? Rental. So what happens, this 1500 is payable in 3 installments, 500 each for 3 installments. In the very first installment, 500 rupees is paid by B. And A is giving his plant and machinery for use. If the second installment 500 not paid or defaulted, then A can repossess the plant and machinery. Then B says, sir, already I gave the 500. No, that 500 is considered as rental for the 1 year's usage. That's why each and every payment will be considered as rental. On the final payment, ownership is transferred. Ownership is transferred. Until the time, A is the owner. Okay, A is the owner. Though A is the owner, for the taxation purpose, B can claim the depreciation as B being the beneficial owner. Already we have studied in income from house property, the same logic. You not necessarily being the registered owner, you can be the beneficial owner as per the financial accounts provision. The seller A being the owner. Until the last settlement, whatever the payment the hire purchaser pays will be considered as a rental income. Okay, rental for the usage. If he fails to pay any of the dues, automatically that asset is taken by the seller himself, means he is the registered owner. Any depreciation may be claimable by the beneficial owner buyer B, and that too the payment, the depreciation is allowable only for principal value, not for this one. If the rate of interest being 15%, the 15% can be claimable on this 1000 rupees. 150 can be claimable. Is that clear? Now, in case leasehold assets, okay, then who is eligible to claim this? Lessor is eligible. In case of lease, hire purchase is different, lease is different. In case of lease, lessor is eligible for claiming the depreciation. Whether it is a financial lease or operating lease, in financial accounts the term may be totally different, but here it will be totally different. A gives his plant and machinery for use to B. For that, B makes a lease rent payment. The name itself, lease rent payment. So from this, it is very clear A is the owner, and A has to pay A has to claim the depreciation. As he is the owner, he is eligible for claiming the depreciation, not for B. Not for B. Whether the lease may be financial lease or operating lease, whatever it may be. So what is called financial lease, what is called operating lease, those things we will study along with the according standards lectures, not here. So whether it may be financial lease or operating lease, both the cases, the lessor is the owner and he is eligible for claiming the depreciation. In case of this one, accounts purpose, financial lease means B is the owner, operating lease means A is the owner. That's how it's classified in financial accounts. That will not be applicable here. Here in both the cases, lessor is the owner. Now, I got a premises rental, okay, premises, a building rental. The rent may be say 1 lakh rupees per month, okay. In that premises, I do false roofing and other things, partitions and internal arrangements. I am doing lots of facilities, right? Interior decoration. It costs me 15 lakhs. This interior decoration, I do know, will have 3 or 4 years life. Then it will not be expenses, it is capital expenditure. But I am not the owner for the building, I am only paying the rent. I am not eligible for claiming any depreciation on the building. But any capital expenditure I do on that leased or rental premises can be considered for my depreciation purpose. For this 15 lakhs, of course, I can claim the depreciation. So, capital expenditure on any leasehold asset, of course, allowed. So, these are the 6 points you have to understand in case of depreciation calculations. The rest will